5 stocks you need to pay attention to as an investor. When I say investor, I believe that value investing and investing in general are the exact same thing. So what I need you to do is, if you like this, I need you to subscribe to the channel because we do a lot of videos, a lot of great content. And if you watch 4 or 5 of our videos, you will walk away with a better understanding of money, and you will have the opportunity to look at my face and hear my voice for 4 or 5 videos, which could possibly be the best thing that ever happened to you. So 5 stocks: Microsoft, Google, Apple, Nike, American Express. Now, I'm not saying go buy them today. That's part of this process. But these are 5 companies that I think have an amazing moat, a high return on invested capital, and great balance sheets. But the important question is what's the right price to pay? So let's use our 8-pillar process and start out with Microsoft. Microsoft is currently even for the day a $1.7 trillion company with an enterprise value of $1.86 trillion. What does that mean? Enterprise value is if you bought the entire company with all of its debt attached to it. So there's about $160 billion of debt there, net of all cash. All right, 5-year PE is a little high, but look at these margins. Huge profit margin. This is after tax. Look at this high return on invested capital. Let's just go look, by the way, all-time high was almost a year ago, $350 a share. It's currently at $227. And I guarantee people a year ago have said, that stock's not going to go to $227, let alone in a year. It'll never go to $227. Guys, it's going to go further down. So let's look at the 8 pillars. What I love to see right here: high ROIC, high revenue growth, high net income growth. Similar shares. I don't like the fact they're buying back shares when the stock is presumably expensive right here. That's okay. Low debt and high free cash flow growth. But again, the 5-year PE is almost 35. The 5-year price of free cash flow is 35. Now, that in and of itself does not make it expensive. If you're part of our community and if you've watched our channel before, you know what I mean when I'm saying that. If you're new to it, pay attention. And it might seem daunting, but it's not. You just need to repeat it over and over like I did. The benefit you have is you have a source of learning through YouTube, through this channel. So if this company was going to grow 20% a year for the next 20 years, I'd buy this all day today. But we don't know what it's going to do. Let's look at the analyst estimates. Look at analysts. They're showing over doubling of profit in the next 4 or 5 years. Very high growth levels, earnings per share, and revenue growth, 50% increase in the next 4 or 5 years. So there's still growth there. Microsoft is attached to everybody's life. And as the world becomes more and more modernized, we still have the entire continent of Africa that needs to be modernized still. All of China and India, they still have a lot of modernization to do and still has huge potential for companies like Microsoft, Google, Apple, Nike, and American Express. Every single company we're talking about today. That is why I picked them. These are companies that can become multi-baggers if you buy them for the right price. What's a multi-bagger? A multi-bagger is a company that you buy that you hold for a long time and it grows 5, 10, 15, 20 times more your money. But you got to hold it for a long time. And most importantly, pay the right price. So what's the right price? Let's go to our stock analyzer tool. Now, I'm going to do a 10-year analysis. If you go look at my Microsoft videos in the past, there's going to be different numbers for each one. The idea here is to get a general idea of where we stand, okay? So the very first line, revenue growth. I'm going to say for the next 10 years, let's say it's poop and goes to 5%, 8%, 11% as my high side. Profit margin, I'm going to say 28, 30, and 32. And same with free cash flow, because free cash flow and profit should be the same over long periods of time. Should be very similar. And you saw that here in this company. It's pretty similar. Now, PE. This is the PE that's being asked for at the very end of the 10 years. At that end, it's still a huge company, much bigger. So the growth potential is going to be smaller. So you have to factor that into the PE. So I'm going to go with 14, 15 and a half, and 17. And same with the price of free cash flow. And finally, for desired annual return, the higher my assumptions, the more margin of safety I need. And that's what your desired return is for. What's your margin of safety? Now, we were already conservative here. So you want a lower desired return, but you can invest in the stock market at 9 or 10%. I have some people who make these low assumptions and still put 10% in here. Me personally, I like to put in a little bit higher. I'm going to go with 12, 13, and 14%. I hit the analyze button. And remember, guys, you need to watch this over and over because this is all about repetition. I know this might sound confusing, but it really isn't once you hear it more and more. The people in our community, thousands of people have learned it very, very well. And we use it every single day. This is the most popular part of our website. Boom. Low price of 110, high price of 188, middle price of 144. All right, so it's still showing it has ways to go. I have it on my watch list at 195. Doesn't mean I'm buying it at 195. It means I'm going to start selling puts on it at 195. So if I want to sell puts, let's say, for example, and what that means is I want to give somebody the right to force me to buy the stock in the future at a certain price. It allows me to get paid to wait for the stock to go to the price I want. So let's say, for example, I wanted it at 180. Let me go to March 17th, 2023. So 130 days from now. 180 strike price, $3.83. So I can sell somebody the right for $3.83 that forces me to buy the stock at 180. Now, what's the risk? Well, the risk is two things. The first risk I'm not worried about. It's basically saying, well, on March 17th, if it's 150, I'm still paying 180. But the reason I'm selling it at 180 is if I wanted it at 180 is to say I'm buying it when it hits 180 no matter what. So on March 17th, it's 150. I either paid 180 for it beforehand or I'm forced to pay for it for 180 on March 17th. What's the difference? The real risk I see is sometime in the next 130 days, something happens where my thesis on Microsoft totally changes, and I don't think Microsoft is worth 180 anymore. I think it's worth 120. Oops. That's the concern. So this, again, is a good way for me to make $3.83, which is about 2% of my money for the next 130 days. So that's about 6% a year, just waiting for stocks to go to the price I want to go to. And this is a great way to generate income so you can feel comfortable waiting for a stock to fall. Because I know I'm with you. Sometimes I'm like, man, it's so close to my price. Why don't I just buy? That's why I do the options. I sell puts as a way of giving myself something to do and be paid to wait for the stock to go to the price I want it to go. If it stays above 180, I just keep the $3.83. If it drops below 180, I keep the $3.83, but I also get the stock at $1.80. So I'm essentially paying $1.76 for the stock. All right, next company, Google. Let's go to the Goog. Again, market cap of 1.15 trillion, enterprise value of 1.23, very little debt. In fact, they have on cash on hand, total current assets of 166 billion, 116 billion of that is cash on hand, and total liabilities of $105 billion. So they can pay off all their liabilities for the entire company with just the cash in their bank accounts. How incredible is that? So this is the kind of company like Microsoft, when companies have low debt, it's so difficult to go broke. It's about staying out there. Look at these margins. Let's go see the main page again. 56.1% gross margin, bottom line profit margin of 23%. Not as high as Microsoft, but still phenomenal. High return on invested capital of last year and 5-year of 14.5%. All-time high, February 1st of 2022 at 152. It's currently at 88. Now, this one specifically, I remember reading a comment from somebody when they said, oh, Google will never go that low. It's below where they said it would never go to. And guess what, folks? I think it's going lower. Because if the market goes down and down and down, the biggest market cap stocks will be dragged along with it when people are selling their ETFs. It's going to be completely about just selling everything. Does that mean you should bail? Do not bail. Just be patient. All right, so let's go to the 8 pillars. Just like Microsoft, we got a high PE and a high price to free cash flow, and everything else is looking pretty awesome. Again, buying back shares when it was a little expensive. I don't really like that. With a 5-year PE of 25.5, it's not the worst. And I can make justifications for Google at this price, but I'm looking for higher returns. Next company, Nike. Guys, Nike ain't going away. Nike's been around for a long, long time. Same thing with all the other companies. All-time high of 180, 93.94 currently. It's low recently of $82. Another company, it's not going to fall that much. This is the kind of stuff that has to happen. 8 pillars look familiar. Now, the one difference is they do have a drop in their 5-year free cash flow. So it makes me go, okay, let's go see what happened here. Well, it was a fluke. Okay, whatever. It is what it is. It doesn't bother me. I'm going to focus on this 5-year average free cash flow number. Doesn't bother me at all. But again, I'm finding great companies and I want to wait for them to get to the right price. If you watch our other videos, we go through Google and Nike and American Express. The last part of this video will be on Apple. Apple, I'll do a stock analyzer tool on it to see what price to pay. So remember, if you like what you see so far, keep watching and subscribe to the channel. Next company, American Express. Now you might be like, oh, this is the Warren Buffett. He loves this company. Yeah, American Express is awesome. I have an American Express. It's great customer service. It's kind of like the luxury of credit cards. Very high margin, good growth, good profit margin, not the greatest, but the PE is only 15 with a 5-year price of PE of 19. But I want to sit here and see why it's only 15 now. Remember, look at this big jump. I mean, it's really jumped up in profit a lot. Is this sustainable? I don't know. Now, one thing I'm going to look at American Express for is go back to the previous recession, back in the late 2000s. So you look at 2005 for revenue. So we have 22 billion, 23, 27, 29, drops to 25 and starts to build back up. All right, so it dropped. Let's go to the net income line. 3.9, 3.5, 4.1, 3.3, 1.6, 3. So it's actually, yeah, it had its fall, and this was a bad recession, but does that mean it's going to be bad? I don't know. This could be an okay time to buy. I don't know exactly. 8 pillars. Now, the 5-year free cash flow is hard because of the kind of company it is. The debt level, you don't really know, but I mean, everything else is a check mark. So keep it on your radar. The high, it was in February of this year at 200, and it's only at 150 now. It's only dropped 25% from its high, which is still, I think, worse than the market. But either way, it's like, okay, this is something to consider. And I'm going to actually look at the options for American Express here. AXP. So let's look at American Express. Oh, how about I type in the right name? American Express. Let's go to January 20th, and let's look at $130. So guys, somebody's willing to pay me $2.70 for the right to sell me American Express at 130 in 74 days. So that's essentially 2% for 74 days. 74 times 5. So this is basically a 10% annualized return because there's five 74-day time frames in 1 year roughly, and 2% times 5 is 10%. So I'm going to be paid 10% to sit there and wait for American Express to hit $130 a share. If I keep on doing it over and over again and I never get assigned the shares, I'm still going to make 10% on my money. All right. Final company, Apple. Now, Apple is interesting. And the reason being is our buddy Warren Buffett's buying Apple. Now, his Apple purchase, I believe, is sub 140. So he's probably buying Apple now. I have no reason to believe that other than just when he was buying and then stopped buying, I was like, maybe I think 140 is his price. The all-time high for Apple was January of this year, right at the beginning of the year, at 183. And the low was 129. And that low was back in June, around June 15th or June 16th. So we're still 5 or 6% away from that, 7% away from that. Let's look at the 8 pillars first. Does this look familiar, guys? Great companies, just overpriced. And it makes sense, guys. When times are booming, the biggest companies, they get to be large because of a lot of enthusiasm. It's a voting machine in the short run. Everybody loves Apple. They bid it up. I personally believe that Apple will be the last stock to fall the hardest. That'll be our indication that the market's close to a bottom, is when people have given up on Apple. Tesla, I also believe that, but you see Tesla's having a lot of troubles the last few days. So let's look at our analyst estimates for Apple. Guys, not a sexy business. Earnings per share, 4 to 6% a year for the next 4 or 5 years. Growth. Revenue growth, 2 to 5%. So it's not a fast-growing business. So you got to pay the right price for it because it's not going to grow a ton. So what's the right price? I don't know, but let's put it in here. Revenue growth, 2, 4, and 6%. Let's say they crush it on the 6% side. Profit margin, let's go with 20, 22, and 24%. Free cash flow, 22, 23 and a half, 24, and 26. PE. Now, guys, it's quite the moat. It's got a high return on invested capital, so I like it, but I still want to be somewhat conservative. I'm going to go 13.5, 15, and 16.5. And finally, for my desired return, I will be doing 12, 13.5, and 15%. Hit the analyze button. Now, guys, again, before I show you the numbers, remember, these numbers don't mean these are the right prices to pay. These are the prices for me to pay. Do your own research, join our community. You'll be able to talk to thousands of people in here about your investment ideas and get an idea of what's going on. But remember, subscribe to the channel, and don't forget, this is a process. You're in the learning phase of the process. Trust me when I say it will get easier. So the price for Apple, hit the analyze button. It's a lot lower than everybody else. I'm at 60 to 90 bucks with the middle price of 75. I have it in my watch list at 100 so I can start selling puts. So that's the way it is. So again, guys, thank you very much. Subscribe to the channel. I appreciate your time.